All right, my name is Carlos McCord, CPA, and today we have another stock analysis of a great cybersecurity company. I think you're going to like the financial results of this business. So a reason why I started looking into this company, and it is Fortinet, ticker symbol FTNT, is because Google just acquired a company, Wiz. They acquired Wiz for $32 billion, and it's a cloud security platform. So the thing is with AI, and even separate from AI when it comes to IT and security, threats are becoming more intensified and more complex. So just like technology advances, people use it for good and people use it for bad. So these security companies, cloud security, they need to beef up their capabilities to be able to handle the complexity and the increased intensity of these threats. And this is why I became interested in Fortinet. So Google just acquired Wiz, and now hedge fund managers and other traders and investors are starting to pay a little bit more attention to cloud security and IT security companies. So looking straight into it, Fortinet, here we go. Fortinet, FTNT right now trading at about $84 per share. Now remember, Google acquired Wiz for $32 billion, and this company right now is $65 billion market cap. So pretty much this company is double the size of Wiz, a company that Google recently acquired. So we see that overall a pretty significant uptrend, more recently a downtrend. So we're going to look and see if we believe the quality of this company justifies the current valuation of $84 or about $65 billion. So looking at beta, always got to pay attention to the volatility of the stock. Right now, 1.1, a little bit more volatile than the overall market. But for a tech company, this is not really volatile at all. This is a pretty solid volatility, I would say, for long-term investors who don't want a lot of volatility in their portfolio. Earnings PE ratio is 37. Earnings per share, 2.2. So this is where we are right now with this business. So let's break into the financials and break down what we think about this business. So starting off with revenues, right now, 5.9 billion. 10 years ago, a little bit over 1 billion. Now, if you notice, double-digit growth each and every year. So over the past 5 years, averaging 22% compound annual growth. So they are currently in the high growth state. They dropped to 12% this past year. So we don't know if this is going to be a long-term trend as far as decreased growth or not. But over the past 10 years, double-digit growth every year, very solid. Now, another thing I love, in combination to the revenue growth, we got to have that. We have an improvement in margins, 71% in 2015 and climbing up to 80% in 2024. So great combination, increasing revenues consistently and increasing in efficiency, meaning for every dollar that they bring in, once they cover the cost that it takes to deliver the product to the customer, they have 80 cents left. They were at 71 cents, but now they're at 80 cents after they deliver the product to the customer. That's where the gross margins are at. That's a solid trend in both revenue and margin. So we love to see that. Let's look at profitability. Are we going to see the same trend? We do have 3 years of negative growth, but that was not since 2019. Every other year when revenue or profit went down, it bounced back up. 303%, 958%, 49%, and double digit each and every year after that. So we love to see that. Net profit margin, 0.8% all the way to 29. So yes, this company is consistently becoming more profitable. I'm looking at both gross margins and net profit margin along with the revenues growing. So this is a great combination so far. Free cash flow, we should see something similar to the profit trends when we look at free cash flow. So let's see, no years of negative growth, hasn't gone down at all. Double digit every year except for this year. So that growth looks like it was restricted in 2024. We'll see if that continues or not, but strong trend in cash flow, solid growth up to 1.8 right now. 16% over the past 3 years annual growth. So again, solid rate. We love what we're seeing. So let's take a look at the debt of the company. How much debt do they have compared to their free cash flow? How quickly can they pay off their debt with their cash that they generate? 0.5, 0.6, 0.7, 0.8. Whenever they've had debt, they've been able to pay it off with their cash flow in less than a year. This is a solid, very strong balance sheet, very strong position for them to be in. So we love what we're seeing. Strong revenue growth, strong margins, increased efficiency, strong cash flow growth, and also they are leveraged pretty well. They don't have a lot of debt sitting on their books, and the debt that they do have, they can knock it out very quickly with their free cash flow. We love to see it. They don't pay a dividend, but just look at shares outstanding. Here we go. Not only are they growing consistently, they're taking some of that cash that they generate and they're repurchasing shares, reducing the share count. So not only do you have a company that's growing, if you were holding this company over this time, they are increasing the value of your shares by doing this, increasing the earnings per share, bringing the share count down. Love to see it. So right now we're seeing that this company has all the tools of a quality business as far as their financial results are concerned. So let's go to the economic value added, and we're seeing the same thing. Very high returns on capital. So we're looking at the operating income and comparing it to the capital that they have. So we're talking about the debt and the equity. The return on capital, 27.9%. We compare that to the cost of capital, the debt on the interest and the opportunity cost of the equity that they have on their books. Instead of investing it in the market and getting 10%, what are they going to get instead of that if they put it back into their business? So their cost of capital is 2.8% and their returns on capital 27, which means the value that they create year after year by keeping their doors open and running their business is 25%. So economically, this company is getting 25% better every year on average for the past 5 years. Amazing spread here between return on capital, the weighted average cost of capital. So right now they're checking every box. Everything looks beautiful with this company. Except the only thing is this past year growth has come down some, but everything else is great. Even the growth that they did have, that 12% in revenues, still solid growth, but down from some of that higher 20 and 30 and 40% growth in the past years. So let's look at the valuation to see what we think about the current price. So I'm estimating a growth rate of free cash flows of about 18% per year. They've been growing at a little bit over 20%. Revenue should continue to grow at a similar rate. I would expect some more capital spend from them as they begin to offer more products and allow companies to just use them for more product offerings, which I'll talk to in a second. Discount rate 10%. I have it high compared to their cost of capital, which is 3%, because I like to use that 10% on many of my valuations. With this company, high growth, strong margins, 80% margins, I believe I can get a free cash flow of at least 25 when I sell. That's what I think quality tech companies are worth. Right now, they're trading at 34 times free cash flow. Just to give you a reference, with the current cash flows at 1.8 billion, almost 1.9, I believe the value of this company is about $85.48, just above the current share price. So it's right above their, or just above the current price. So I think it's right smack dab in the middle of their fair market value. I think this company has a range of about $76 to $94 as far as their fair value range. So right now, this company, in my opinion, priced right at fair value. So what you have to understand is, even if this is wrong, is this still a company that you want to invest in? What's the quality of the business? We looked at the revenues, the margins, the profit, the cash flows. They're repurchasing shares. So even if they weren't making a profit, they're still increasing the value of the shares by buying back shares. So they check off every box. Now with this company, again, I talked about the AI revolution and how, because of it, and like I said, even before AI, the intensity and the complexity of cyber attacks requires companies like this to continue to improve. And this is what this company is doing, along with covering more product offerings. So looking at some research, it shows that executives are saying they don't want to have 2 or 3 dozen different security solutions across their businesses. And some have even more than that. Some companies have 50 different security solutions for all of their products and all of their departments. They'd like to get that down to 15 or 10. And Fortinet is a company that is expanding their services. So not only are they growing their revenues and getting new customers, a lot of their revenue growth is from their existing customers. So their annual recurring revenue is growing and growing every year. So it's a company that's in a solid position. Right now, according to this price, I believe it's a safe investment. They're not in the position to pay a dividend right now because they have so much opportunity to reinvest money into the business and grow. Now, 28% returns on capital. I don't want them to pay a dividend as a shareholder. I want them to continue to put money into the market, continue to invest in R&D and infrastructure if they can continue such high returns on capital. Once that begins to start coming down because of scale and just a lack of opportunities as they grow larger and larger, then I would expect a dividend. But what they are doing, as we saw, they are adding value to the shareholders, not just by growing their business, but repurchasing shares as well. So for those that like those dividends, you're still getting some value from how they're deploying their cash by repurchasing those shares and increasing the value of each existing share. So that's my analysis, quick summary of this business. Let's go to here. Everything pretty much checked. Revenue and margins, profitability, free cash flow, debt. Dividend is also a check because, I mean, they're not paying a dividend right now, but it makes sense for them not to pay a dividend. So their dividend policy, I believe, is proper for where they are. Shares outstanding coming down, value creation, almost 28% return on capital compared to 3% cost of capital. Amazing spread. And valuation, I think they're right on target as far as their fair value. So that is my analysis of Fortinet, ticker symbol FTNT. Let me know what you think in the comments, and I hope to see you in the next video.